On May 16th, two governments signed something the Canadian pipeline sector had not seen in years, a binding political commitment to new oil export capacity. Prime Minister Carney and Premier Smith formalized a carbon price framework in Calgary, and the market read it immediately as a green light for pipeline growth. The consensus view is straightforward. Carbon compromise removes regulatory uncertainty. Enbridge moves forward, Thesis confirmed. But that reading misses what actually moved first, and why the sequencing matters for capital positioning. The deal was not a construction approval, it was Ottawa committing to declare the pipeline in the national interest by October 1, 2026, with a construction approval target set for September 1, 2027. That distinction separates a political signal from a capital deployment event, and investors who treat them as identical are pricing in certainty that does not yet exist. What the deal actually did was shift the probability-weighted timeline forward, compressing the discount rate applied to Enbridge's long-dated backlog. Enbridge carried a $40 billion secured capital backlog into Q1, and that number has been sitting in filings largely unnoticed by investors focused on near-term earnings. When Enbridge CEO Greg Ebel said the macroeconomic landscape is the strongest he has seen in more than a decade, he was not speaking to quarterly results, he was signaling that the external conditions for deploying that backlog had structurally improved. The carbon price pathway the two governments agreed to, $115 per ton by 2030, $130 by 2035, $130 effective by 2040, is not incidental to pipeline economics. It is the mechanism that makes CCS investment viable for oil sands producers. Without oil sands producers committing to the Pathway CCS project, the new pipeline lacks a shipper base, and without a shipper base, no private developer commits capital. So the deal did not unlock the pipeline. It unlocked the conditions under which the pipeline becomes financeable, a narrower but more precise claim. The capital implication is that Enbridge's $40 billion backlog is now closer to deployment on its largest potential addition, but the timeline gate has not opened yet. What the market has not fully priced is the cost structure of the carbon deal itself, and whether $130 per ton by 2040 keeps Alberta producers at a competitive cost basis relative to U.S. supply.
The carbon deal gave the pipeline thesis a political foundation, but the physical supply-demand picture was already forcing the conclusion before any politician signed anything. Western Canadian crude exports averaged 4.6 million barrels per day in 2025, leaving just over 300,000 barrels per day of surplus capacity across the entire export system. That margin of 300,000 barrels per day is not a buffer. It is a rounding error against a projected supply base that S&P Global's Kevin Byrne expects to top 5.2 million barrels per day by 2030. The system was described as quite full through the winter of 2025, and Byrne stated directly that by end of 2026, the peak production cycle should fill it entirely. That physical constraint is what makes Enbridge's mainline expansion structurally different from a growth initiative. It is a capacity release valve on a system with no remaining slack. The first phase of 150,000 barrels per day is already underway, with a second phase decision of 250,000 barrels per day expected later in 2026. Together with Trans Mountain's planned 300,000 barrels per day addition by end of 2028, the math still falls short of the projected 5.2 million barrel supply base. This is where the WTI move from $57 to $95, driven by U.S.-Iran conflict and Strait of Hormuz disruptions, enters the analysis not as a price tailwind for Enbridge, but as a throughput demand signal. Enbridge does not earn more when oil prices rise. It earns more when volumes move through its pipes, and a $95 WTI environment maximizes producer incentive to push every barrel possible to export. The counterintuitive condition here is that Enbridge's revenue model is insulated from the commodity cycle in a rising price environment while being fully exposed to the volume cycle, and a tight physical system with surging producer cash flows is the ideal condition for both. This is the part of the thesis most income-focused investors miss. The 5.3% dividend yield and 30-year streak of consecutive increases are not the investment case. They are the evidence that the cash flow model is structurally stable enough to fund a $40 billion deployment cycle. Canada's inability to contribute to the IEA's 400 million barrel reserve release during the 2026 conflict because it lacked both a strategic petroleum reserve and sufficient pipeline capacity reframed pipeline investment as a national security priority, not just an economic one. That reframing matters for capital because national security designations accelerate federal approval processes and reduce the political reversibility of commitments already made. But the physical constraint also contains the reversal risk, and that risk is not where most analysts are looking.
The reversal embedded in the Carney-Smith deal is not that it might fail politically, it is that it transferred the critical decision to a party with no obligation to move. Oil sands producers must commit to the Pathways CCS project before a private sector developer will anchor the new pipeline, and that commitment requires producers to accept $130 per ton carbon costs against a cost structure they have spent 2 decades optimizing downward. The consensus reading treats the carbon price framework as a resolved condition, but it is actually the opening position of a negotiation that has not started. Enbridge's CEO called the environment game on for growth, but that phrase was spoken before the producer commitment question was resolved, which means capital markets may be pricing the CEO's confidence rather than the underlying condition. The distinction matters because Enbridge's October 1, 2026 National Interest Declaration from Ottawa is structurally dependent on producer alignment happening before that date. If producers delay or fragment their CCS commitment past mid-2026, the October declaration becomes politically difficult to execute, and the September 2027 construction approval target slips with it. The specific threshold to watch is not a stock price or an earnings revision, it is whether the Pathways Alliance publicly commits to CCS investment before the fall 2026 federal declaration window. RBC's price target increase on Pembina from $64 to $68, issued the same week the carbon deal was finalized, signals that institutional capital is already re-rating the Alberta Basin on the assumption that the producer question resolves favorably. Pembina added 110,000 barrels per day on its Peace Pipeline in 2026 alone, and is projecting 5 to 7% compound annual EBITDA growth through 2030, and that projection is already embedded in the new price target. The countersignal is Keyera's Q1 results, a $122 million reported loss driven by non-cash risk management contracts, with distributable cash flow per share falling from 83 cents to 44 cents year over year. Keyera's underlying gathering and processing volumes hit a record, meaning the operational business is accelerating even as the reported financials obscure it, and TD raised its price target to $61 despite the headline loss. That divergence between reported earnings and underlying operational performance is precisely the condition that creates mispricing windows, and it applies to the basin broadly. The basin-wide re-rating is real, but it is running ahead of the specific trigger, producer CCS commitment, that would validate it. Enbridge at $73.33 with a 13% year-to-date return and a $40 billion backlog is not cheap on a near-term basis, but the $40 billion is priced as future optionality, not current deployment. If the Pathways commitment arrives before October 2026 and Ottawa issues the National Interest Declaration on schedule, that optionality reprices as near-term capital deployment, and the income-oriented investors currently holding Enbridge for the 5.3% yield become underweight on what is now a growth story. The May 16th signing date is the benchmark. Every milestone the deal specified runs from that date, and the first hard checkpoint, Ottawa's October 2026 declaration, arrives in less than 5 months. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.